up, everybody? What's up? What it do? What it do? What it do? What it do? All right. All right. Are we trying to make some money or what? Um. So this is gonna be part one of my 10 must-have tech plays. All right. 10 must-have tech plays in your portfolio. Okay. And we're gonna go over them, and we're gonna go over why. Now they're obvious, right? They're obvious. And it's very cliche and everybody's in them. And I get that. And if you're a new investor, you're thinking you're going to find all these new companies, the next winners, and hopefully you will. Because that's the goal, right? But in the meantime, you need these companies, all right? You need these huge, heavy hitters, okay, they're just rolling the profit. They're just swimming in profit and money, and in return that causes the price to go up. Shareholders see that value, and therefore if you own shares of that company, your portfolio is going up with those companies. Okay, we grow as they grow. Okay, so just remember that. That's the whole key to this game. We grow as your companies you pick grow. Okay, so first one on the list is NVIDIA. All right, good old NVIDIA. Dun 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 dun. All right. Anyhow, I hope y'all can see that, read that a little bit. I'm kind of in the way. No biggie, though. Market cap, $4.3 trillion. It is the most valued company in the world right now. Okay? It has an ROE of 115%, which is insane. That's crazy. That's ROE stands for return on equity. Return on equity. ROA, a 61% ROA, that is a return on asset, okay? Year over year revenue growth, 86%. They grew revenue 86% from 12 months ago, guys, from 12 months ago. They've damn near doubled, all right? Net income margin, okay? How much profit do they keep from that revenue, all right? They keep 52%. Of all revenue made, they pocket 52%. Okay, guys? 3-year compound annual growth rate. That is the revenue growth rate. Okay, there's different types of CAGRs. This is the CAGR for revenue. Okay, all these slides, all the 3-year CAGRs is going to be revenue CAGR. Okay, just so y'all know. Feel free to fact check all these numbers. Okay, I encourage you to, in fact. So 3-year CAGR, 20%. Okay, on average, their compound annual growth rate for revenue is 20%, all right? They have $54 billion sitting on the sides, and there are only $10 billion in debt, okay? They have a forward PE of 42, so their projection for the next 12 months, that PE is 42, okay? That's the company and analyst projection, okay? So that's what they think as a company of what their PE will be in the future, okay? All right. Palantir. I love this company. I sold out of this company. I've been kicking myself in the ass ever since. Okay, I've been trying to get back in. The company just won't pull back. It's on a tear. It's just going sky high, sky high. So this is what they do. I'm not gonna break it down. You can read. Market cap, $411 billion company. This company 5 years ago probably wasn't even a $5 billion company or a $10 billion company. They're now a $411 billion company, guys. Their return on equity is 15%. Nothing insane, but it's a good growth. It's decent. Return on asset, 10%. We like above 5, so we're good to go there. Revenue year over year, they are growing 39% from 12 months ago, guys. They've grown 39% from 12 months ago. Net income margin, 22%. So all the revenue they bring in, they are keeping 22% of that. The rest is paying bills, CapEx, whatever else, but they are pocketing on average 22%. Revenue 3-year CAGR 25%. On average, they are growing 25% in revenue a year for the past 3 years. Okay, I'm trying to break down how you guys understand these numbers. All right, this is how you need to read them. All right, when you see them, that's what you guys should be thinking. They have $6 billion of free cash on the side, and they are $238 million in debt. So they're not even in debt, basically. All right. And forward PE, a 276. Their PE right now is like 600. So a 276 PE is freaking insane. It's ridiculous. And the PE right now of 600 is, that's just why I just can't. That's why it's hard for me to jump in this company right now. But Meta, good old Meta. These are must-haves, guys. You need these in your portfolio. I'm not saying go and buy them all right this second. You know, if you need to wait for a pullback like I am, that's what you need to do. The moment it lets you back in or lets you in, period, you need to jump in. These are companies that are really going to take your portfolios to the next level, guys. All right. Market cap 1.9 trillion. Okay. They have a return on equity of 47.7%. They have a return on asset of 42.2%. They're growing revenues on average of a 19%. Over the last 12 months, they've grown revenue 19%. Correction. Their net income margin is 40%, so they are keeping 40% of all money brought in. They are pocketing about 40% of that. All right. Over the last 3 years, their compound annual growth rate on revenues on average has been 14%. Their free cash flow is $47 billion. Their total debt is $49 billion, so they're a little more debt than they have cash. A couple more years, one more year, and I think that's going to change. And they have a forward PE of 28. Okay, guys, they have a forward PE of 28. Meta is a freaking buy right now. Meta is cheap for these numbers right here. For these numbers, all right, that is a freaking super low PE for Meta. Okay, so Meta is a buy. Google, good old Google McDougal. Oh, I didn't put the forward P here, but anyhow, I'll look it up while I'm on here. Market cap 2.3 trillion. This is what they do. All right, they have a market cap of $2.3 trillion. Return on equity is 34.8%. Return on asset is 23%. Well above the numbers that we like. Revenue year over year, so the last 12 months they've grown 13% in revenue. Net income margin, they are keeping 31% of all revenue made. They pocket about 31% of that, so about 31% of that is profit. 3-year compound annual growth rate on revenue, so they're growing about 10% a year right now. So it's not crazy, but it's not bad either. That's probably about average growth stock right there. Free cash flow is $95 billion, or not cash flow, but they have cash on the side is $95 billion, and they are $41.7 billion in debt. All right, let's look it up though. Let's look up the forward PE while I have you on here. Okay. So, who is this? Google McDougal. All right, and let's scroll down here and let's see. Bam, right there. Right there it is, guys. So right now, TTM is trailing 12 months, okay? Trailing 12 months, and they are projections. The company and analysts are both basically thinking that it's going to be about the same 12 months from now, probably about another 20, okay? So if you guys scroll over here, it'll break down what these mean, okay? So if you guys are confused on any of these, just scroll your mouse over it and it'll tell you, okay? Like net income margin, Okay, net income margin is net profit margin or net profit ratio is calculated by finding the net profit as a percentage of the revenue for the last 12 months, right? So basically what it's saying is out of all the revenue, all revenue brought in, this is the percentage of profit they're pulling from that revenue, okay? This is how much they're pocketing, okay? Out of all money brought in, this is how much they're pocketing, okay? So just a little fun tip though, if you guys are ever confused of what any of this means, right? So this is the revenue, compounded annual growth rate in revenue over the last 3 years, okay? These are key metrics, okay, that I look at on every company, guys. All right. These are the key metrics I look for when finding a growth stock, okay? Anyhow, they have 95 billion in cash on the side, and they're only 41 billion in debt. Okay, so they got twice as much in cash. Amazon, I would say is probably maybe the most important company in your portfolio. It's definitely arguable. At least it's at least arguable, because all the stuff that Amazon does, okay, guys, all the stuff that Amazon does, it's just a powerhouse, okay? It is such a powerhouse. Now, why do I have it in my tech play? I have it in my tech play. So Amazon, the reason it's in here as tech, okay, it's also consumer, but it's in tech too, right? It's tech because of AWS, which is Amazon Web Service, okay, guys? Amazon Web Service. It's huge. It's data, okay? Amazon Web Service is data. They have one of the biggest data companies in the world, okay? They make more money off their tech side than they do their prime side, okay? And then that's another thing. So you can shop with Amazon, right? Then you can watch TV with Amazon, okay? So it's like I watch Prime almost every night. That's my go-to. It ain't Netflix. It ain't Hulu. It ain't Apple. Or it ain't none of them. Like my go-to is Prime, is Amazon, okay, to watch TV. I'm not saying everybody's is, but mine in this house it is. I'm sure in a lot of houses it is. It doesn't get talked about much though for the company because they're bringing in so much more money doing everything else. So this company does so much, guys. They really do. They do so much. That's why you need to have them in your portfolio, okay? They have a market cap of 2.3 trillion. They have a return on equity of 24.8%. They have a return on asset of 10%. Okay, remember we like our ROE above 20, above 15 really, but above 20 is great. Above 15 is definitely doable. Return on assets we like above 5%. All right, revenue year over year. So last 12 months they've grown revenue 10.9%, so basically 11%. Their net income margin is 10.5%. So out of all revenue, they're only bringing in 10.5%. At the moment, you know what I mean? I'm sure that's probably low this year, right? That just happens to be a little on the lower end. And their 3-year compound annual growth rate for revenue is 11.3%. So they're growing about 11.3% on average year over year. Free cash, they have 93 billion on the side, and they are 159 billion in debt. So that, they might be doing a lot of they might like be building a lot of data centers right now. They just have a lot of money going out probably for like research and development. Okay, so that's probably why their debt's a little higher than it needs to be. Okay, but that's it, guys. That's it. So this is the 5, and then here's some honorable mentions. Okay, and I'll do honorable mentions on the next 5 too. So AMD is second to NVIDIA. It's just a little mini NVIDIA. The CEO, Lisa Su, is actually cousins with the CEO of Nvidia, who's Jinsing Wang. So yeah, you know, they heavy in that family, heavy in that family. Two of the biggest CEOs in the world. It's crazy. But AMD's a good, you know, they're going to do really good these next few years. They might even do better than Nvidia. If they can build chips that are just as good as Nvidia's, but for a fraction of the price, that you're going to see AMD grow insane, insane. Uh, Snowflake, it's data. It's a data play. It's software, and it's really good. It's a really good company. Well, as soon as they become profitable, okay, if they're not already, but as soon as they become profitable, then all kinds of investors are going to pile into them. Some investors won't even invest into a company until they're in the green. Okay. Uh, Arista Networks. This is literally one of my favorite companies, guys. ANET. All right, ANET is one of my favorite companies because they are so reliable. They always beat earnings. All right, they always beat earnings, and it's just a really good company. And then you have Synopsys. Okay, Synopsys is another good tech play, and you can kind of be a little early on this one if you wanted to pick some up. I think they're going to do really well these next few years. So yeah, man, I hope you all got something out of this. You know, I hope you guys are learning something. You know, I'm not the smartest person in the world, but I just really love this game. And so, for whatever reason, a lot of things don't click with me, but for whatever reason, I just understand the market. I just do. I'm not trying to toot my own horn or anything. I love this game, and for whatever reason, the numbers make sense to me. I love breaking down a company. I love researching a company. I love seeing what it has going on in the future, why it's doing good, why it's going to keep doing good, or why it may slow down. I don't know. It's like I'm addicted to information, right? And so I just love this game, and yeah, I mean, if you start playing this game, like I say, and I'm gonna keep saying it, once you see it, you can't unsee it, guys. Once you see it, you can't unsee it. This will change your future, your family's future forever. If you can figure this game out and play it, you know, play it successfully, this will change everything, guys. It'll literally change everything. Especially once we start getting into options, which is going to be here soon. I think after I do my next 5 tech plays, then I'll start teaching options. Once you guys know how you can stack option money with your buy and hold account, game changer. Game changer, guys. You can grow your account so fast. So, anyhow, love y'all. Play this game safe, though, y'all. Play it safe, okay? You can lose money in this game if you ain't playing it right, all right? All right, love y'all. Peace out.